Hey guys, it's Danny here with another investing episode. So I got a little sloppy on my um, picture taking of what happened, just because it got sloppy. I mean, there's a lot going on. It's hard to really keep up with it. It's also at this point I've got kind of dug in on the NLY position. Very happy with it. Think it'll work out very well for me overall. Returns have been good up to 42.39%, and that is with the big Zim dividend not kicking in there. Not all of my portfolios are doing quite this well. One of them's doing very well, another one's kind of like, but it's actually doing okay. But it's a little bit lagging at this point. But I think that, you know, everything's going to go well for me. I'm doing pretty good, so I'm pretty happy. I don't really like to count Zim in my dividends, but yeah, I'm well over $20,000 a year, including Zim. Now Zim's a little bit of a crazy one, but um, that kind of gets me to my thought process. I was actually thinking through because obviously I've got a pretty high dividend thing. I want to kind of diversify a lot. Um, what are big targets? Diversify, obviously. Maybe we've got covered calls, like the a QILD. But looking at the Nasdaq, I mean, I wish I had a chart of that. But Nasdaq. It's interesting that the Interactive Brokers has been comparing my returns to the Nasdaq, which are comparable and slightly favorable. Um, but I would also say I'm not comparable to the Nasdaq in that Nasdaq is an extreme valuation. I am around valuation or significantly under. Um, whereas Nasdaq is kind of sky high, which you know, with investing you kind of just have to. I think of it like a football game. You have to think about where you are in the game. Um, and like for example, um, you know, it or a baseball game, whatever. It's Nasdaq. I mean, could Nasdaq keep running? Yeah, it could. The market can be insane for a while, but I mean, I don't think Buffett is crazy wanting to pull back because, um, you know, Nasdaq is at such extreme valuations that people are starting to compare it to .com. Also, Bitcoin is really high. If there's any crash in Bitcoin, I think that's just going to send chaos to some of these um, companies that have exposure. Uh, I wish I had, sometimes I just start and then I get on something, and I wish I had more prepared. But whatever, we just do one cut and then ooh, we found a chart for it, the Nasdaq. I think this will be pretty if it looks good. All right, so we're gonna run over to the chart of the Nasdaq, and that's kind of why I'm talking about. Like I don't want to be as heavily exposed to the Nasdaq right now. There we go. Okay, so obviously that's the P/E ratio of the Nasdaq. Nasdaq, has been on a big run of 40%, but most of it has been um price earnings explosion. You see, price earnings was at 24, and now it's at 48. I guess that's not. Well, I guess it's a 1 year versus 1 year, so it's 40% return on the Nasdaq, but it's been 24 to 48 PE. So that would indicate that almost. Well, actually, that would indicate that the that's a 100% jump, isn't it? 100% jump versus in valuation versus 40% return. That would almost just indicate that not only 100% of the Nasdaq's return is valuation explosion. It's just become more expensive. Now people are really excited about the future of what the Nasdaq is offering, but it's really just excitement. It's not reality at this point. It's not like the Nasdaq has made a lot more money. Um, it's just price earnings explosion. I mean, I'm sure somebody's gonna come along and tell me I'm wrong. I mean, and it's subtle. I mean, obviously there's Nvidia blowing it out, but on the other hand, with that blowout, the price is also blown out. So the price has actually gone up much more than the earnings in the Nasdaq. So yes, the earnings have increased in the Nasdaq, but the price has increased so much more than the earnings have increased that it's actually much more expensive now on a price earnings. Which is 48. Well, let's go 5 year. You see on the 5 year, the highest we got was back in uh, 2020, at 34. So we're way above that now. I guess it's not going to let me go longer, but you just see in that price evaluation, usually it likes to be in that 20 range. So we're at a pretty extreme valuation now, which kind of means that the Nasdaq has a lot to prove. But whereas me, my holdings, I'm pretty much in line at price. NYL is close to book. Zim is way below book. I guess my exposure to QYLD is PSCC is way below book. I mean, there's a lot of reasons for that, but it looks like they're trying to make their book more quality. So hopefully that'll kind of lead to a turnaround. But obviously, my exposure on PSCC is more limited. Um, and I've discussed it. It's not. I made a lot of money on it. I made a huge amount of money betting that the problems weren't as big as they were. Just a lot of money, and then I got cold feet and I got out, and then problems did end up being pretty. I guess it just became that a lot of their financing became in question. That's one of those things where you sometimes learn things, and the company's need for financing, and if the financiers just get cold feet because they don't want to get burned, and that's one of the things that I start to realize. A lot of these investing professionals, they're pretty haphazard on their returns. I mean, they do well, but they're not really that killer. And the reason for it is, frankly, they just want to make sure that they don't make mistakes. They don't want to lose their jobs. They're really defensive. They're not really out to make a lot of money. You'll see that with Zim. They didn't buy Zim early. They bought Zim really late. Yeah, they're going to make a lot of money on Zim, but you know, why did they buy Zim late? They don't want to be wrong. They don't want to get fired. It's not worth it to them to make, 100% profit when they can make 20% profit and be 100% safe in their job. 100% profit where they could lose their job, not so good for them. So that's kind of the funny thing, is that a lot of these fund managers, you start to realize that they are extremely cautious. Some of them, most of them actually, there aren't really a lot that want to rule the world. Most of them just want to fat paycheck, and obviously they want to beat the index, but they aren't actually looking to blow the top off the world. Um, Sorry to get really random and philosophical, but we went to Shanghai index. Um, Shanghai index is holding strong, actually increasing a little bit. Obviously, there's the fear of tariffs, but also we got the automation strike coming up. Um, I mean, maybe it's avoided, but I feel it's happening. Now, is it 1 or 2 days, or is it a couple weeks? Um, I just, it's a big catalyst. Um, but yeah, going back to my actual investing, you know, I got exposure to Sim in here. And so some of the initial slides, shows my initial exposure to Zim. And then you actually see that I don't know, hopefully you can see it, but the so in the subject it reads the company, the date of the strike, and or the call price, and then the call price. That's what they have the right to get it at. So actually, in one of the later slides, you see the call price changed. So apparently, special dividends, and this is something I didn't know, they added a special dividend. They affect the call price, which makes sense. Actually, because that's cash flow that is probably not going to come out in December. So, but it kind of is a little frustrating for me because it changed the price slightly below what I bought it at. But on the other hand, it's kind of like, neither here nor there. I mean, the one you'll see later is a lot below because I bought it at a much lower price. So I sold it at a lower price. It's actually technically a profit there, but you'll see that my average is 22.20, and then I've got 22.16 in there for most of them, and then 21.16. So I mean, obviously that means that, especially if we get an IRL strike, there is a pretty solid chance I lose all of that, or all of this gets called, all of this, $12,000+ in stock gets called. I mean, it will be called at a slight loss. But on the other hand, what am I getting out of this? By selling these calls, I picked up $1,000 worth of income. I mean, my actual loss on share price, I think, is just eyeballing it, maybe $100, maybe $150. But I sold $1,000 worth of options, so right there's $850 in plus side. Plus, then you're talking about, we took a off of 500 of it, we took a $3.60 dividend. That's 1,800. So I mean, 2,800, and then minus, it's still like 2,600 plus profit on that if it gets called. So that's pretty strong, and that's kind of why we're rocking right now is Zim in here. Some of my other accounts I got in Zim at not a good price, but I think it'll be solid. I think it's gonna. The good thing about those is those aren't optioned in. I don't didn't option them. So I'm just gonna wait. Hopefully the strike comes, and then I think it'll pop. If the strike comes and the strike is anything more than a few days, I think it'll pop above where I bought it and sell it for a profit. So I'll take the huge dividend and then sell it for a profit. Worked the NYL calls, made sold them pretty because they were obviously they were getting closer. So I got pretty good profit selling those, and then I rebought long because I want to stay long as I can. I don't actually want to get called on this dragon. I just want to keep selling the calls. So obviously, I sold these 51-cent calls. Those are super deep. And then I sold these. I guess those are a strike of 20. Huh? The strikes is 20. Nani? What? Did I sell 20 strikes? Ooh. What is? Oh, okay, yeah, I guess I've got some 20 strikes. Yeah, because I've been selling some 20 strikes, for some of it because I bought some below 20. My average is actually 20.46. I'm selling the majority at 21. So, but I mean, again, I've picked up, in there, like $500. But the big thing is this is yielding 13%. So I've already taken, a 65, cent dividend. I've called multiple times on these. I'm gonna keep calling as much as I can and keep taking the dividend. And that's another thing too, is I want to keep extending out when possible. So this $500 on NOL, I don't really want to wait to the call point. I want to, stretch it out. Hopefully, it's not moving up too high. I think it's in my opinion, NYL will. This is my gut. Will continue to move higher, but it's going to be like a long burn, and so obviously, I want to get close, and then buy it back. Make sure there's no chance of getting called. Reoption. Of course, the 20s become a little concerning in this long burn. They could get called, but I mean, on the other hand, it's stuff I bought at a lower price. Um, and it is what it is. If it gets called, I mean, I think this is the right sort of strategy for me where I am. But also, I've got quite a lot of leverage in here. I guess I didn't create a leverage slide, but I'm at 1.74, which is a little bit above where I am. But actually, I kind of accounted for that with the Zim dividend coming in. Zim dividend. Actually, I pushed my leverage a little bit up. With the Zim dividend coming in, it'll actually push me back into sort of an area where I'm pretty comfortable with the Zim dividend coming in. I guess the only other thing I'm going to go over on this is kind of like, I was talking about diversifying, because I've got a pretty high yield, little high risk, but not really high risk. I think it's really to me actually this is much lower risk than other stuff. How I feel is it's that this is actually a fairly low risk strategy. I know people wouldn't agree with that, but I think it is. Um, but I do want to diversify. So actually, one of my thoughts was Income Realty. Actually, it's a blue chip, extremely safe. 5.6% yield. And what it does is basically it leases long-term leases to companies who basically just pay rent, and they don't really have any. They handle all the upkeep of the buildings themselves. Um, so it's kind of like Income Realty just sits back and makes money, and they're very successful at what they do. But so that 5%, they grow the dividend constantly. So you think about, I mean, let's just I have no idea how much it'll grow, but let's just say in so many years that 5.6% dividend is going to double based on my cost, to when it doubles, it'll be 11% plus. It's essentially going to be you know as barn burning as this in a long time, but because it's a blue chip, is extremely safe, the valuation will also pop. So it's kind of like it will be this on yield in a long time. So I'm not going to get that yield up front, but I'm going to get the growth. So it's also going to be something that's more sellable in terms of profit, whereas some of this has more potential of um, decline, whereas Income Realty is going to be growing and thus appreciation. So I'm thinking of building a fairly major position in Income Realty. It is a little bit below my cost of the leverage, but I think I can actually, by selling options on it, put the yield above the cost. Plus, it's growing. I think that it'll be very additive and also um, add a lot of stability and, in a way, um, make it really easy to have a sort of drawdown potential on this portfolio. Drawdown in that, let's say I want to begin taking money out of it. I would like to take the leverage to zero. So I do want to have that consciousness of how do I have a drawdown strategy on this? Not that I will draw down, but you have to to me you have to have your eyes on various things, Um, I mean, if it's going well and I don't really feel like I want to access income, I think the leverage is going well and it makes sense in the environment to keep the leverage. Holding the leverage makes sense, especially if Fed keeps cutting. Fed keeps cutting, I think that we're gonna see an increasingly lower cost on the leverage. The lower cost on the leverage is going to make the leverage even more desirable for this sort of portfolio. So there wouldn't be any real interest in drawing it down, especially because I've got lots of reserves and cash reserves, other accounts that don't actually have any leverage. So having leverage here, it's not like it's sort of like I want to look to the possibility of how to make it easy to draw it down, but I don't. It's kind of like you just want to keep those options open. I mean, obviously, like without like just trying to be like, oh, we're gonna sell a bunch of NYL to bring the leverage down to zero. It's like how would it be effectively easy to draw it down fairly quickly without without changing the yield mixture, which if you essentially stuck a lot of income realty in there, for example, um, which is appreciating, then you've got something that appreciated. If you wanted to very quickly draw it down, you could just, after the option expires, just sell it all, because you have taken a capital gain, hopefully. Um, but in any case, I think income realty is going to add a lot of stability to my portfolios in all the accounts. So actually, pretty much in all the accounts, I've got a number of accounts, but in all of them, I'm pretty much planning to add some income realty. How much, I don't know, but um, I could easily see adding like $50,000 to income realty. I mean, I think it just makes a ton of sense. Now, is it the best option in the world? I don't know, but it just makes a ton of sense to me. Um, but I mean, different portfolios, different things. Also, just see the options. I mean, you'll see what happens. I mean, Zim, if all the Zim gets called, it's also just seeing like, hey, if all the Zim gets called, what happens to the container index? Where does the container index sit? What happens to the Nasdaq? A lot of questions. Just see where it falls. Try not to get too far ahead of myself and just take things one step at a time. I think that um, in investing, sometimes we get in trouble if we plan too thoroughly because it's just really about price, price, price. I mean, obviously there's the meta of the direction of things. You have to watch the meta and the price, but I mean also it's like it doesn't, it's so many factors, so I don't want to get too far ahead of myself either, But I do want to diversify, and I think that, you know, obviously that's a good goal, but on the other hand, diversification isn't everything. I mean, because I would just say if you're making a ton of money, that's your margin of safety. So, but I mean, it also just depends where things go. If income realty, for example, kicks up really high in price, then it may look to other options, or I mean, just depends too. Say for example, Zim skyrockets in price, it all gets sold off, and then it nosedives. It sometimes does. And then maybe you say, hey, it's a chance to get even more Zim. But you just have to kind of be fluid and flexible. And to me, um, like the saying, be like water. I guess Bruce Lee said that, or I don't know if it's Chinese, whatever. I mean, it's wisdom actually. In some cases, there are times where it's good not to be flexible, but in investing, I think mostly being like water, being flexible, being willing to flow, not being fixed, is a virtue. So anyway, till next time, peeps. Hopefully that was not too wild, but hey, it is what it is. I tell you what I'm doing, keep it real, hopefully, and um, hope all you maybe got some, at least had fun. I mean, this is for entertainment, but hopefully maybe you got spark some ideas for your investing. Obviously, you're responsible for what you pick, but good luck out there. All right.